Why is there such a lag? Okay, folks, welcome to Thursday Night Stock Charts Live. Sorry I'm late, a little bit of a technical issue. If you see me staring weirdly due to a delay in front of your computer right now, that's the technical issue. It's really weird. We have a lot to go over tonight. We're going to talk about the news that reversed the markets today. I frankly think it was a pump of the market early on, and it was looking for a reason to go down, and they got it. They got a very, very big reason. We're going to talk about the implication or the impact of the capital gains increases. They're going to happen. They're going to happen. It's just a matter of when. Will it be 2021 or 2022? If it's 2022, you probably won't see as serious as selling. Excuse me, let me retract that. If they're going to include 2021, meaning they're going to claw back all of 2021, you're probably not going to see as much selling because you're screwed anyway. So why bother selling? Might as well just hold. If they say it begins January of 2022, look out below for this market. It's going lower, a lot lower. So we'll talk about it. We'll talk about Intel's earnings. We'll go over the weekly charts. How do we appear poised to close out the week? Because we need to know now, by Thursday night, how the charts look so we get prepared for Saturday. And that's when I review with members the week ahead commentary where we do our strategy session for the new trading week. So very important analysis we'll be doing tonight. But as I always like to say, there's one trading day left to go. So those weekly charts, they can look one way on Thursday, but another way on Friday. So let's be careful. And this is just our pulse check of how we might close out the week. First, let me go to our highly esteemed sponsors. They're TrendSpider. Automated technical analysis. Use algorithms to identify your trend lines. If you're new to technical analysis, why not manually draw your trend lines, then go to TrendSpider, overlay the automated trend lines to see if you're accurate. If you're experienced, like me, manually draw your trend lines and then double check your accuracy. Maybe you'll learn something. I learn something new all the time using this product. So automate your grunt work, speed up your technical analysis, improve your accuracy, reduce costly analytical mistakes. Trust me, by using the alerts with a rules-based approach. If this, then that. If that alert fires off, then you make a move. If it doesn't, you avoid. That's how you reduce costly analytical mistakes. No impulse buying. Use their scanners to find winning chart setups. 35% discount code below. Using that link below. And they have, what do they have? A demo tour, 7-day free trial offer. I believe in it so much, I give it away free to our silver and gold level members. So check it out, TrendSpider. Okay. So this was probably I've never seen Zero Hedge publish so many articles about one topic in my life. There's got to be a half dozen regarding this capital gains increase. It's that significant. So initially, when Biden proposed his tax increase during the election, it was going to be on people earning $400,000 or more. That is now a household income of $400,000 or more. His only rule, because he's open to negotiations on this, is that it can't affect anybody below the $400,000 threshold because he's working man's guy to go to. That's for now. Because when you see what they're going to do with this money, it's going to be insane. You want to talk about the largest transfer of wealth in human history? You're about to see it. So if you're wondering, why is the dollar not ripping through the ceiling? Because we're going to pay down debt. Because we're not going to pay down debt. We're going to print more money. We're going to tax. We're going to spend. Not only are we going to spend, we're going to spend it on, you got to love this one, Human infrastructure. This is the biggest welfare package we've ever seen. It's taking from your pocket into the pockets that do not produce. It's taking from your pocket, going to the government. Inefficient money will now be spending efficient money. And that's how you grow the economy, by when people have, the private sector has the capital in hand to work with that capital efficiently. You grow the economy, you grow productivity, you grow GDP. You grow our way out of debt, because that's the only way we're paying off this debt. What he is doing, he's taking that money. He's going to contract GDP. He's going to reduce productivity. How do you increase productivity when you can't invest more in your business, machinery-wise, to increase productivity, because you got to give it to the government? This is a disaster on so many levels, and the only calculation I wanted to know was this. And the calculation outcome was this number. See if you can guess what it is. What was it? Let me make sure I'm right. 566. 566 equals the number of days from today until we get the midterm elections. So the damage that could be, remember, this guy's only been in for 4 months, not even 4 months yet. This is just the beginning. I'm not even going to go into the reintroduction of the Green New Deal. So this is, it's Armageddon for capitalism. So buckle up, buckle up. They're not coming for those with 400,000 or less in income now. They will. It's coming. So I'll pop these articles into the chat box. And I didn't say hello to everybody. I need to say hello to people. And I know people don't like when I talk politics. It's not really politics. It's not. There's going to be an awesome amount of red pilling done. For all these rich pseudo-intellectuals that voted for this potato, wait till their tax bill comes. So it's not going to be pretty. The market took it on the chin today. Watch for the details. They can walk this back. The problem is that the worst case for the markets right here and right now is if they make the tax cuts effective January 1, 2022. If they say they're going to go back and they're going to anything that you sold in 2021 is subject to the new capital gains hike, then why would you sell? Why would you sell? So watch for the details to roll out here. I think the bias is going to be the downside. And let's face it, folks. Let's go to the weekly charts here. You take a look at the Qs. All right, let's use the Qs. First, let me say hello to everybody. We'll come back to the Qs. John Spencer. Morning, John. John's over in New Zealand. Any comments on the 5-year TIPS auction release? Negative 1.631. Is this the current rate minus inflation? Well, you get capital appreciation on the TIPS. So, no, I think that's taxable. 1.63 is taxable, but you get the capital appreciation on the bond. So the bond appreciates as inflation goes up higher, but it kicks off a yield. Not a great yield, but it kicks off a yield. Hey, Franklin, thank you. Yes, please smash the like button. Subscribe to the channel. M. McNeil, hello, sir. RL, morning to you. Mac Carter, hello, contrarians. Hope all is well. Bullish on baby. Bullish on babyface Bob tonight. Okay, so he got me. So he picked it off. I shaved my beard for the summer. So, and that's what my wife said too. I said, "What do you like better, the with the beard or without?" And she goes, "Well, it's a two different looks. You know, when you're wearing your baseball cap, you look like and you have a beard, you look like a fisherman, like your average Joe. You just got off a boat. Now that you have no beard, you look 10 years younger, have a baby face, and you have that corporate look. So, and she wouldn't tell me which one looks better. Typical female, no offense to the females out there. We love the female audience. We embrace you. We love you. We want you to join us. But that was the response from my wife. Good catch. We'll take a look at TLT. Chewy, hey, how you doing, pal? The sky is not falling, Bob. Frankly, I'm short. I don't care. Let it go. Bob, what a great pump up. Thanks, regular. Danny, hello. Thank goodness. No bed. Yeah, no bedhead. I accidentally went live. I had to delete a video. I made it private, and I'll go back later on. And I woke up. Was it this morning? I think it was this morning. Yeah, it was this morning. I wake up, and I have a good head of hair. So when I wake up, my hair is like all over the place. So usually I take, here, I could take the Encode. I'll show you what this is. I could transition off and on. So I thought I took it off, but I didn't. So I start seeing myself in the video, and I see my hair is like up here. So I delete the video. I put it on private so nobody could see it, but it stuck out there. There was like 3 or 4 views. Did you see it, Denny, or no? I deleted it ultimately. It's gone now. Big Bear. Yeah, gym. Yeah, that's right. I'm back in the gym too. I've been in the gym for a little while now, doing a lot more exercises. Went to the doctor today. My cholesterol's down, and not cholesterol, blood pressure's down. Not that I have high blood pressure, but it was getting borderline. K Invest, good evening. Whoa, no beard. Yeah. It was a tough decision, but I saw myself getting color up here. I'm like, man, I want to open up the pool soon. And if I shave it a couple of weeks from now, I'm going to have 2 different colors. Excuse me, folks. Okay, so let's get to it. When I got heavily into technical analysis, it was really immediately after 2000. I always appreciated the charts, but I never really understood divergences, the higher level view of the market. I was always into the daily and intraday charts, and that's what I looked at. And then after the dot-com bubble hit, and I looked back and I reflected, I said, man, that was a beat, and I never want to go through again. How could I have avoided this? So I learned the charts, and it's multi-time frame analysis. You have to have multi-time frame analysis because you look at a daily chart. Oops, wrong chart. A daily chart. And, hey, we just broke out to new highs a few days ago. So what could be wrong? But then you take a look back. And you look at, what the heck happened here? At a weekly chart, things start to come together. And we've been in a bearish divergence on RSI, on the triple Qs for, I don't know, 3 quarters. So this is pretty damning technically. And we're hitting new all-time highs. And when you take a look at certain stocks that lead the triple Qs, such as Microsoft, of which we are short. Microsoft on a monthly time frame has RSI 82.29. Gets better. Quarterly chart. RSI is On a quarterly basis, 94.56 on Microsoft. It gets better. Yearly chart. Yearly chart, we have RSI 94.81. And they just caught 2 upgrades, one to 275, another one to 300, just in the past couple of days. And we are leaning into, on a yearly time frame, for, what is this now? 1, 2, 3, 4. This will be the 5th year that we tapped the 3rd standard deviation Bollinger Band on Microsoft. It's a great company. It's a great company. I'm not knocking it, but it's a bubble. This is, by very definition, a bubble. So it's a technical disaster area. So that's why we're short of it. We opened up new short positions on the triple Qs today. I stopped out a few days ago because we had broken out. It was like Max Payne time. You know, we were waiting for hopefully a lower high here versus this high back in February, but ultimately we broke out, and I stopped out, 100% out of our short on the 13th of April. And I was long of the SQQQ. So today, I have a, traders are, we're a superstitious lot. So I don't like after I get stopped out. If I sell something, I'll go back into it. If I get stopped out, if I force myself to stop out, I don't want to go back in. I want to use a different tool. And that's just my quirk. We're suspicious. That's superstitious. So what I did is this, rather than, this is a weekly chart, rather than buying the SQQQ, I sold deep out of the money naked calls on the TQQQ, the leveraged ETF, putting you long of the Qs. And the reason is that this is a leveraged ETF, and you have that leveraged ETF time decay that helps you when you short. So I'm selling premium. If we break out to a new all-time high, I'll worry then. But if we roll over here, then I'll continue to book profits, roll down, book profits, roll down, book profits, roll down. As long as I stay one standard deviation out of the money. So that gives me an 84% chance of profitability on each trade. That's using the profitability rules. And I've been doing a lot of options trading lately. We changed our strategy from being directionally long one way or short another way. So I said, you know what? I'm going to keep our shorts on that we have existing. I'm going to set stops. Rules. I don't use stop loss orders, but we use rules. If we break out on the Qs, we're going to stop out. That's what we did. But we broke back down today. So, and we've been going for cash flow generation, selling strangles, selling naked puts, right now selling naked calls. Everything to generate cash flow. Because it's more market neutral. I don't have that much of skin in the game. So right now we are long of gold miners. The trades that we're looking to put on, gold miners, gold, silver miners. What else? Emerging markets. Because when you take a look, and by the way, before we leave this chart, I sold, if I didn't say it, the 120 strike, which is one standard deviation out of the money. And that's 84% chance of profitability. All right, so where was I going? Oh, EEM. So here's EEM. And there are great opportunities coming, folks. I'm bearish right now, but I'm looking forward to bargains, because this guy This potato in the White House is going to wreak havoc. So let's go to a monthly chart. So EEM, look at how far the S&P 500 has come since 2009. Now, EEM sold off hard during the financial crisis, but it never really broke out. It's just been consolidating like a son of a gun. So as our current government forces capital to leave this country, that's what they're going to do. The wealthy are going to take their U.S.-based hedge fund money. They're going to put it in the Caymans. And that's where it's going to stay until they get a new friendly administration that comes in. That's the way this works. They're not paying anything additional if they don't have to. So where is our next bull market? You're looking at it. You're looking at it in terms of emerging markets, in terms of commodities. This is the CRB. You see the nascent, the very, very early stage of a commodity bull market developing here? It's happening. It's for real. And we're very, very close to, what's that? What is that word they use in space? I don't know, like clearance, something like that, where we clear these obstacles and we go from putting in lower highs, lower lows to all of a sudden we're putting in higher lows and higher highs. That's new bull market. What's going to drive this bull market? Well, let's go back here. This is what's going to drive it. Human infrastructure. The stealing of wealth from the productive and giving to the unproductive. It'll always ultimately end back in the hands of the productive, but in the short to intermediate term, it's going to be painful for the productive. Also, for those that are thinking that this is going to pay down debt, no. This is just beginning. We're going to keep these printing presses going. They're going to spend. The Green New Deal, wait till you get that bill. So this is a disaster area. And that is what's going to help drive up the CRB. And whether it be gold, nice cup, downward sloping handle. Get ready for the next bull run here. SLV. We're long on AGQ. It's a leverage ETF. Silver putting in higher lows, higher highs, waiting to break out. I mean, this is where you want to be. Corn. Bill Gates, now the largest farm owner in the world. Why? Take a look at this. We've been in a multi-decade, not a multi-decade, that's being hyperbolic. We've been in nearly a decade, about a decade's worth of a bear market on corn. That is over. You now have a new bull market. And it's a bit late to buy right now. I would wait for the pullback. We're going to get a pullback. In fact, I think they sold off today. No, they were still up. I could have sworn I saw some commodities sell off today. Maybe it was soybeans. I'm not going to harbor hard. No. Maybe I'm seeing things. Okay. I thought I saw them sell off. Anyway, this is a new bull run. I don't agree with Kramer on most things, but one thing I do agree with him on, there's always a bull market somewhere. You just got to know where to look. And what what's the cause and effect? What will be the effect on the market of these policies? Well, inflation, we know it's here. The chart's telling you it's here. The stock market is a measure of inflation. It's here. But you're going to have money come out of one sector and now go into other sectors. McCarter, thank you very much. Can't afford to pay for new money with old money. Can't afford to pay for new money with... Very true. All right. So let's go through some charts. Bond market did very, very well today. TLT broke out. You're going to see a lot of money rotate into bonds now. The dividend on the S&P is in decline while yields on bonds are moving up higher. If they're going to tax you to death, sit in bonds, less risk. Wait for the new administration. So TLT moving up higher. It broke out on the week. Look what it did today. Nice breakout on a daily time frame. And so, you know, if you want to know what do traders think about the tax increase on inflation, because people think automatically, oh, he's going to pay down debt. No, that's wrong. That's wrong. That's not what he's going to do. Printing presses are going to still keep going on. You got to take a look at the tip market. The tips are up on the week. And they close higher on the day. So the tips are telling you, with their move up higher on the day, they just went positive on the week today, that they're expecting more inflation coming down the pike. That was the reaction. So I think the tip market has it right. And the pontificators out there who are going to say he's going to pay down debt, they don't know what the frick they're talking about. Bond yields. Did this update yet? 22nd? Yeah. This is updated. Very weak. They're probably going to move down lower. The US dollar. Let me make sure this is updated. Yep. Okay. So what we did this week, and this could cause short-term problems for the dollar. Is that we're poised to close back above a support level. So we may be putting in a higher low here. Because what the dollar did today, and I think the dollar traders, currency traders got this wrong. The dollar moved higher today on the news. But they're thinking logically. They're not thinking like a Marxist. So they're thinking that, okay, good, we're going to raise taxes. We're going to attack the fiscal problems of this nation. No. War has been waged on this country today. They're going to take money out of the economy. He announced it on a day where, while initial jobless claims fell, you still had over 500,000 initial jobless claims on the week. That's more than double than what we had pre-COVID. So you're taking money out of the productive, giving to the unproductive, and you're printing money. And you're going to cause all these people with this money to go out and buy goods that aren't being produced. That's inflationary. The dollar is not going to behave well with this. So the knee-jerk reaction here on the dollar, it may last a little bit longer, but ultimately it's going down. Gold is going up along with silver. The VIX. If we close where we're at or better, or even a little bit lighter, we have a breakout on a weekly time frame. Stokes are now hooking up. So momentum is beginning to find equilibrium and beginning to side on the side of bulls. Daily chart. An outside bullish reversal bar today. Take note of this. This is what we look for. The market sends you signals. Just like I showed you with that declining downtrend channel on the triple Qs on a weekly time frame, the market's been sending us a signal. So when we look back after a major market correction, it's easy to armchair quarterback. It's harder to be in the moment and say, you know what? Something's not right here. It's technically wrong. And the policies that are being pushed forth, meaning printing money, tax hikes, with jobless people on government doles at 17 million, give me a break. So what we're preparing for is a sell-off here, and that's why we're short. You're getting higher lows. We broke out on RSI. We hooked up higher today. No new weekly high, but we're close. And I really meant to say new daily high versus the 20th, not a weekly high. We do have a weekly high. The Dow Transports, very interesting chart here in that if we were to have closed today being Friday, we would have back-to-back doji star formations. These are indecision candlestick formations. So traders are telling you right here, right now, as of Thursday, we don't know what to do. There's a tug of war at all-time highs, and that usually does not end well. Usually you go down. RSI at 78, which is pretty high for the transports. Daily chart. Bearish reversal bar. I drew these lines a couple of days ago on RSI. And I was watching for either a breakout or a breakdown. We got the breakdown here on the 19th. We recaptured on the 21st. We have now again failed on the 22nd. I think we're going lower on the transports. We were down on volume. This is finally the first volume down day we've had since March the 23rd. Dow Jones weekly chart. We're now down, over a percentage point on the week. Volume's going to roll in light. Unless we have a major sell-off tomorrow, it's going to roll in light. MACD fading. Watch your histogram bars. I don't care about the lines. I care about the histogram bars. That's your momentum indicator. Daily chart. Stokes are rolling over. The cost of shipping and containers will be inflated even more come May. Yeah. Dow Jones daily chart. Bad day. But volume was not bad. So here's if I were a hedge fund manager right now and I had the ability to buy any stock I would want or sell any stock that I want, large cap, mid cap, small cap, I would hold on. I would not sell right now. Not my blue chips. I would sell my high beta. I'd get rid of that. And I'd stick with my blue chips. So I wouldn't be shocked if the Dow Jones doesn't plummet because those are your blue chips. S&P 500, very extended here. Weekly chart. Volume is going to roll in light. Let's see how volume reacted today. Not bad volume. So I would love to come on here. Oh, excuse me. Why is this? I got to delete this chart. Daily chart. That wasn't a daily chart. Now it makes sense. I was wondering why volume wasn't higher. Okay, volume. Rolled in about average today. RSI, lower highs, lower lows now. Stokes rolling over. I just want to check out a 1 hour chart. We were bid off the lows of the session. I don't think we're done going down here. Look at the volume in the final hour of trade. They tried to bid it back up, put in a higher low, bid it back up, and they sold the strength in the final half hour of trade. See a lot of volume bar here on the 15-minute chart, but when you drill down to a 5-minute chart, you get your aha moment. Big hedgies dumping at the end of the day. IWM weekly chart. We're down 1 1/3% for disclosure. We are short of the small caps. And if I were a hedge fund manager right now, if I had to sell, I'd be selling these. I'd be selling my beta. Anything that's got high volatility, I want out. I don't want to have to sit with it for 5 years and hope that they move up higher. I want to sit with my blue chips and get paid to wait. Daily chart. Bearish key reversal. This is not my annotated chart. And this is what we've been looking for or looking at, being short of the small caps. And it's two things. One, you take a look at a monthly chart of the small caps, and we are trading up and at the third standard deviation Bollinger Band on a monthly time frame. Unsustainable. So that's the reason why we got short of the small caps. Now, it's been if you want to talk about the market sending you a signal, you take a look at a weekly chart of the small caps. We've done nothing. And you could argue for the past couple of months, you could argue we're consolidating here. That's why I drew these lines to mark a triangle formation. But if we break to new weekly lows this week or next, it's all over. Because when you take a look at a daily chart of the small caps, head and shoulders setup, left shoulder, head, right shoulder. And note the declining relative strength indicator. Stokes will open up tomorrow down below 50, as I always like to say. When Stokes are trading down below 50 and declining, rallies fade. Just like you saw today. The rally faded. 4-hour chart. Head and shoulders setup. Left shoulder, head, right shoulder, neckline. We break and close down below 206.82 on the IWM. It's done. It's all over. Confirmation breakdown. The banks. The banks are not going to like declining yields. They put up with it because they believed it was a short-term correction. But after today's announcement, the banks are not going to like the yield pulling back. That hurts their NIM, net interest margins. So expect weakness on the banks. We're down on the week by nearly 2%. Daily chart. We've already broken down. We had broken out above resistance. We've now failed. Volume was light. Beware the banks. Technology. Down over 1 3/4%. No new weekly low yet. Volume is very light. Very, very light. Daily chart. Here's your line in the sand on the XLK. One might think it's here, and they'd be right. The reason is that this line here represents a breakout point. Remember that we were consolidating for a couple of months within this trading range. We broke out on the 8th of April. If we fail to hold this, that's a bull trap, a breakout point failure. In all probability, if we get that, we retrace all the way down here to the lower band of support. And many times, it breaks. That's the probability of what's going to happen if we fail to hold 138.95. Semis, hammered this week. Down 3.5%, threatening to break support. Double top potential here. We have a lower high. We break 216.14 on the SMH, it's all over. Bear market for the semis. And I'm being hyperbolic for a reason, folks. The charts don't lie. If we break 216, I'm not saying go short the semis tomorrow. I don't know what they're going to do tomorrow. I have my probabilities grow exponentially to the short side of making money if we close down below 216.14. So that's what I'm looking at. Look at the failed recapture of support, or the fast line recapturing the slow line on MACD. This is pretty bearish stuff. Watch the momentum indicator. We've begun to lose momentum yet again. Daily chart. Bull flag set up under a lot of pressure. Stokes trading down below 50. What happens? Rallies fade. We were up. We closed down. RSI, very bearish. You know, here's a classic divergence. The market sends you signals. There you go. You don't need this. You don't need this. This tells me 1,000 words. Volume was light today. Biotechs. They're off the highs of the week. Stokes are very oversold. I would avoid right now. The reason is that you're going to have anxiety. I love the Stokes. I love RSI. And maybe I'm wrong. But one thing I do know is this. I'm trying to find a cool color. All right, we'll use that. Choose. You had the 50-day moving average in blue here, rapidly declining and threatening to take out the 200-period moving average. So there's a lot of anxiety when you see this setup occurring. Usually after the event occurs, obviously you get that negative event on price once you get that crossover, because everybody on Wall Street, death cross, all the hype. But then right afterwards, you get a rally back. I'm not saying it's going to break out, but that's normally what's going to happen. But I would avoid right now, as these moving averages are not looking good. They're going the wrong direction. The fly in the ointment of my analysis is this, is that the indicators are setting up pretty nicely. RSI is rising. In fact, it may have even broken out today. It did. But these are not above 50 yet. Just observations. I'm more worried about the moving averages. Consumer discretionaries hammered this week, down 2%. Light volume. Daily chart. Light volume down day. Not much to talk about here. Energy. Energy took it on the chin. You're going to take from the productive and you're going to give it to the unproductive. Do you need that much energy? As much as you anticipated? Daily chart. Oh, by the way, we're one trading day left to go. This could change, but we've broken weekly support. We had a nice little wedge formation going on here. We've broken weekly support. Maybe it's going to rally back tomorrow and recapture. Daily chart. Oh, man. This is bad. I'll show you what I mean. This is just bad stuff. You never want to see a rounding top below 50 or below 20. You always want to see Stokes move up above 80, circle around up there, dip, recover, dip, recover, dip, recover. That's your bull market. Any book out there, Technical Analysis for Dummies, or any of these wizards on YouTube that tell you short a stock or sell a stock when Stokes go above 70 or 80, they're out of their minds. And if you're short, you're going to go broke. But you certainly don't want to go buying stock when the Stokes are rolling over down below 50. This is horrible, horrible momentum. This is a forward-looking indicator, and take a look at RSI. Lower highs, lower lows, down below 50. Watch out for energy. I bought ExxonMobil a few days ago. May have to stop out. Oil has broken out. It's consolidating. As goes oil, so goes energy. Gold. Now, gold has had some very, very good weeks. A few weeks ago, I shared with you on, it was either Sunday night Stock Charts Live or Thursday, where I spoke about seasonality on the gold miners. I'll show you later on. I use TrendSpider about how we're in the beginning of a very, very strong period for the gold mining stocks. And you've seen very, very good performance, today being the exception, with the gold mining stocks. Now, gold is broken out. It broke out last week. We did a retest of support this week, but we're still up. We're flat. Daily chart. Now, gold pulled back on the day. Why? It's because the dollar rallied. Why did the dollar rally? Oh, we're going to get more fiscally responsible. No, we're not. No, we're not. No, we're not. So this is a blip on the screen. And as I showed you earlier, agriculture prices, the CRB index, the commodity index, moving up higher. You want to own the dollar or you want to own gold? I choose gold. Bob always catches when the Stokes are down below 50. Yeah, you know, it saved me a lot of money, man. It saved me a lot of money. I won't say it made me a lot of money. It saved me a lot of money. Because I just avoid. I avoid. Or I hedge. The GDXJ. We broke out last week. We're doing a retest this week. Franklin's on here. We may have been given a reprieve on our covered calls. Franklin's had we both sold covered calls, and I don't know if pre-drag is on tonight, but we all three of us sold pre-drag and Franklin members sold covered calls when GDXJ was taking a nosedive. I said, I'm hedging here. I'm going to throw on a hedge. I didn't want to sell, but the stock like immediately rebounded. And so we have one of two options. One, let them expire worthless, sell puts against the 47 strike or the 48 strike, generate income, wait until they're put to you. Or two, roll out and up, meaning out in time, August, around the 55 strike. Those are two options. Or simply wait out the clock to see whether or not they expire worthless, or as near the money as possible so you could roll out and capture as much credit as possible when you resell those covered calls. So that's what we're doing right now. Franklin and pre-drag were smarter than me. They went closer to the money. Actually, I think I made an error on the alert. I said the 27th, and I actually sold the 30s. So my misfortune was their good luck, and my inaccuracy was their good luck. So theirs expire tomorrow. I got to wait another week. It seems like an eternity. So GDXJ looking good here. We're retesting a weekly breakout. This is healthy stuff. What time is it? Oh, there's only 6 minutes left. I got a chart request. I can't believe I've been talking this long. You guys should have stopped me. All right, I want to show you something on TrendSpider. And I went over this several weeks ago. Oh, Franklin, remember we went over EPI this morning. Look what it did. It did as expected. It gapped up and into resistance, then it faded. All right, so here's GDXJ, the gold mining ETF. April. No, this is wrong. Let me go back. No. It was just 5 years. Yeah. So over the past 4 years or so, let's go back one more. This is better. Over the past 5 years, April, very strong, up 67% of the time. May, 60%. June, July, up 80%. This is the seasonality factor that we've been trading, and that's why I don't want to have these calls or these shares taken away from me. We are long of the NUGT, which is a leveraged ETF. I don't want to treat that as an investment, though. I'd rather keep the GDXJ. So that's a seasonality on GDXJ, Netflix. We booked a profit on Netflix. We traded the earnings report. I opened up a strangle. I went over that for members that want to review that trade. I posted the exact trades, the buy, the opening trade, and the closing trade. It's under the Slack channel, option selling. So just go there, check it out. I published all of that. So we closed that out on this gap down, and we did well. So Netflix. All right. Netflix is on the precipice. And here's the value of the automated trend lines, folks. You don't know what to make of this sometimes, right? Until you throw your trend lines up. And we are on the precipice. We break down below. This support level here in green, it will mark a significant breakdown in the stock. because we had broken out here in February out of this triangle formation. We spent months within this triangle formation consolidating. We broke out. We never followed through. Never followed through. And now we're on the precipice of breaking down. So if we break down below, if you had to say, Bob, when is it all over for Netflix? I'd say around $4.90 per share. We break down below that mark, it's all over. Netflix is going a lot lower. Till then, I wouldn't short it. It's too much support in you. We spent months and months and months consolidating in this range. If you short into these levels, it's very high risk. It looks like a very bearish chart, and in all probability, it's going to break. But your risk reward is not in your favor right now. You're better off waiting for the break and for the market to tell you, listen, this is done. And you'll know when it's done when you get high volume bars. And we don't have that yet. Even if you drill down to a weekly chart. Last week, very light down volume. This week, obviously, on earnings, it picked up. And we have a lot of support in here, as noted by my annotations will take off and the automated annotations. You got to wait for these to break before you short it. Me personally, if I bought, I'd put a stop loss right below the lows of the week and get out quickly. Daily chart. Bearish key reversal on the 20th. Gap down on earnings. Spinning top. Another spinning top. They may rally this. They may even rally it up to fill the gap. Either here or for an extreme up here at 539. More likely is the 529 mark. But I think we're going to break down on Netflix. The 20-year weekly chart says Netflix is bearish. Yeah, I don't even think you can go back 20 years on Netflix, but it's pretty bearish. You have lower highs. All you need now is you break to a new lower low, and it's all over. All right, TLT. I'm going to blow through these really quick. I got to make a phone call. TLT. Weekly chart, good. We have a lot of resistance up and around that 141, 142 mark. But we did break out on the day. Above resistance. We do have another resistance level above, right, in green. So it looks good. It's probably going up higher. So TLT, if stocks sell off, TLT is going to go up. What else do we have here? LRCX. Lam Research. Avoid it. Again, the power of the automated trend lines, folks. You would have known to have sold if you had your trend lines up. So we hit the upper band of resistance. I'm not of the thought that we're going to pull back to this lower band of support right away. We have a lot more support. Let's see if the monthly trend lines pick this up. No, they don't. So I like $557.55. If that fails, $503.56. If that fails, then we're coming down here to the lower band of support. Right now, I'm not confident we're coming all the way back down there. On a daily chart, I think we're definitely going to go lower. I mean, this is an outside bearish reversal bar, and it's a breakout point failure. Or a bull trap. We broke out here, April the 1st. Really no follow through. Rounding top, failure. It's going lower. Avoid it. We'll leave off with BBW. Build-A-Bear. I've traded this. It was either an extreme overbought stock a number of years ago or an extreme oversold stock. One of the two. Weekly chart. Healthy chart. Daily chart, it's stair-stepping higher. Nothing not to like here. Daily chart. We broke out today. Broke out above resistance. It bucked the market. We broke out above a volume shelf. We have another volume shelf up here. How was volume? Volume was not good. Warning flag on the track. Volume was not good. So just be careful with this one. I like it. But if you really want to be careful, wait until we close above this resistance level here at around 856 on rising volume. You want to see rising volume. That's continuation move up higher. Larry, I forgot. Yeah. Thank you, sir. Jedi Kid, who's Larry, bought me two of these and caps. Thank you, Larry. Thank you, Franklin. Thanks, everybody, for joining in. I appreciate your time very much. I hope you get value out of it. And please smash the like button if you could. Tell a friend. I don't know. Do something. Leave a comment. Share with a friend. Have a great weekend and have a profitable trading day tomorrow. Be well.